Time now for this week's quote of the week. This one comes courtesy of management guru Peter Drucker, who once said in quotes, "I never see anything in the future. I don't believe in it. I look out the window. I look for things that have already happened and not yet had the consequences and are not yet perceived." Gosh, welcome to Money Talks. That's all we ever do on this show. The consequences of the aging population, unfunded pension liabilities, unsustainable health care, the buildup of deficits and debt, things that have already happened, but we're just starting to feel the consequences, and they're not generally perceived. Peter Drucker. Very pleased to welcome back to the show Greg Weldon. I mean, this guy is, I always say Greg is the best introduction I can give for Greg is, this is the guy that other analysts read to find out what's really going on. You hear a number, a headline news number, well, I promise, Greg's gone 19 layers below that to figure out what's really going on, an international scope as well as domestic scope. Greg, welcome back to the show. Thank you for taking the time.
My pleasure, Michael. Thank you.
And I also say, you would never have heard this, Greg. I said, I wish I had your speaking voice. I myself sound like Mike Tyson's son, and then we bring an adult on like you.
Thank you.
Let's start with the big picture stuff here, and I'm just going to throw some things at you. Obviously, when people go to weldononline.com, they get much more, whether looking at Weldon Live or the Trend Tracker. You've got managed accounts, that kind of stuff. But let me just throw things. We talked just a moment ago about, to Victor Adair and to Rob Levy about that OPEC meeting. It did have an impact on oil prices. What did you make of it?
Well, I think there's two key takeaways. The first one is bigger picture, and that would be Saudi Arabia, their domestic economic situation, the fiscal austerity that they announced actually before the meeting, which in my mind totally set up this deal. The Saudis are pretty desperate. I mean, it's almost as if they kind of declared war on U.S. frackers and are losing that war. Their domestic situation, they're cutting salaries of government workers. I mean, it's pretty severe in terms of their budget situation, number one. Number two, you know, the fact that they're willing to deal alone is significant. So that's the bigger picture issue, which I think is very positive, potentially longer term. I think in the short term, however, the fact that they're cutting 350,000 barrels and Iran is going to be allowed to continue to increase production. They're at 3.6 million barrels a day. Their goal is to get to 4. That would instantaneously, and it won't happen instantaneously, but if they were to reach their goal, that would wipe out what the Saudis are cutting. So that's kind of a negative in the sense that this is not that big a deal, quote unquote deal. But on the other hand, the fact that Saudi Arabia is willing to cut production and allow Iran to continue to ramp up because of their own domestic situation in the House of Saud is really interesting to me, and I think that's more bullish longer term than the negatives.
Let's switch over to, we talked just a touch earlier about the U.S. presidential event. Let's start with number one. Do you look at that as an important variable in the markets? Two, you see all this focus on the debates. You got 2 more to come, so should that be sort of a notice of a little more chaos in the markets or at least volatility there? Can you give us your perspective on that?
I would say yes and yes. I think, you know, clearly it's going to be important. There's winners and losers on both sides of the equation. The thing that does worry me a little bit about Donald Trump being a kind of a conservative libertarian is his stance on foreign trade. I mean, protectionism is potentially the worst thing we could pursue right now. So it'll be interesting to see, you know, if he does get elected, how severe he might be in pursuing some of these deals he's talking about, and just in terms of getting countries to pay for their own defense and stuff like that. Obviously, Hillary Clinton has negatives in terms of, you know, some of the healthcare business and in general, capitalism in general. I think it's interesting to watch one currency cross that can tell you kind of to some degree how the market at least is perceiving this, and that is the Russian ruble against the Mexican peso. Peso down when Trump is doing well, Russian ruble up when Trump is doing well. So from that perspective, the peso rallied this week, and although the ruble got hit off the debate, it actually rallied too on the back of the oil deal. And frankly, if you look at some of the oil-producing countries, Norwegian krone broke out this week, Russian ruble broke out this week, even something as peripheral as the Indonesian rupiah broke out this week. So I think that that's interesting to me in terms of kind of supporting the thought process around this was a positive week for the energy sector. I try not to get too involved in politics. What I can say to you, Michael, from my heart, it is somewhat embarrassing to watch that debate, knowing that these are the two best candidates that our country can put forth to our people. I mean, seriously.
Yeah, I've been on that theme for, since they both got the nomination, but when they were the presumptive nominees, I said, a country of 340 million people, and this is what the democracy has come as, that's the choice. I do think that's the bigger story, and I think it has long-term macroeconomic implications, financial implications, because you're talking about two people who come into power with the highest disapproval rating in history. This is going to further divide the nation, whichever one it is, and further erode confidence in government. So, yeah, I think that's a big story. Greg, let me just reiterate. So you're saying if Trump isn't doing well, the peso goes up, but are you also...
No. Peso goes down. I'm sorry, dollar peso goes up. Peso goes down when Trump is doing well, and the ruble goes up when Trump is doing well.
Okay, there you go. Wow. Okay, let's shift. Let's keep going here. I mean, the other big focus has always been the Federal Reserve. We look at the will she, won't they. They're not going to raise interest rates. Obviously, now in September they didn't, but now we're looking at December. Again, let's start with two things. How significant would it be if they did raise in December? It looks like every time it looks like they might, the market doesn't like that too much. But again, do you suspect that that would be a longer term kind of flow through into the markets?
I have to say this could be one of the most difficult positions outside of being in a crisis that the Fed will face here. They kind of have a conundrum ahead of them. If they're truly data dependent when it comes to the macroeconomy, when it comes to final demand, when it comes to manufacturing, when it comes to jobs, when it comes to all the things they talk about, there's no way they would be hiking rates here. On the other hand, you have a situation mathematically based on the calendar, as simple as that, where inflation is going to rise if oil just stays where it is, let alone if it rallies from here. Take this, for example. Gasoline prices at the wholesale level in the futures market bottomed last year in February below $1. They're $1.40 now. That means come February, you have a 40% year-over-year increase in the price of gasoline. You're going to see that across the board in the energy sector, and that's going to influence the inflation data significantly, because headline inflation and core inflation are two different pictures. And if headline inflation catches up to core inflation, which it likely will, you will have achieved the Fed's goal. And from that perspective, they should be hiking rates. Not only that, but if they don't hike, that would tend to bring the dollar down, which would lift energy prices and make it even more, potentially tricky going out further. So, it's, to my mind, it's kind of 50-50. I think there's a really good case to be made that they should not hike rates. And if they wanted to say, hey, we see this rise in inflation coming, but it's calendar-based, it's not to the sense that consumers are paying more for gasoline in December than they were in September, that won't be true. So it really is tricky. It's 50-50, but the futures market is only attaching about a 38% chance that they'll move. So odds are they're not going to hike rates, according to the market.
Well, I look at some of the economic indicators, and I think it's fair to say that we're not talking about a robust economy in the States. Are we talking about a C or a C plus kind of thing? And yeah, you can compare it to what's going on in Europe, and that looks awfully good. It's better than what's going on in Canada. But and I'm just wondering to the degree that the Feds must now keep an eye on what's going on internationally. I mean, if they raise rates, I think that's just a big check mark for a lower Canadian dollar, lower euro, that kind of stuff against, at the very least.
Absolutely. And in the case of Canada, you bring up a good point, because we just had a slew of data, which outside of the trade data, which was export-based and mostly commodities and autos, when you saw the retail sales, it's 3 months in a row that it's below expectations, and 2 months in a row where retail sales fell when they were expected to rise. Throw in inflation, where CPI was much lower than expected. The Bank of Canada is in play for sure. And I think we spoke about this last time too, that they are expanding their balance sheet almost in a stealth way significantly right now. So, and you also have the fact that you have dollar LIBOR rates rising, and you got some regulatory changes that are driving that, but you also have the Fed, whereas, Canadian LIBOR and Canadian dollar deposit rates are pretty much staying where they are, to the degree that they're now below the U.S. rates for the first time in a while. So the Canadian dollar flirted with a big breakdown this week and then kind of rallied back on the oil deal. But I think the Canadian dollar is very, very vulnerable here. We talked about that last time, and I stick with that call.
Greg Weldon is my guest. You can find him at Weldon Online, WELDON, weldononline.com. As I say, this is the analyst that other analysts read on a regular basis, and certainly we're very lucky to have him with us on the show. But I've got to come back and talk about an area that he's done extremely well in, and that's, of course, identifying the lows in gold and silver. I want to ask him about that when we come back on the Money Talks Network. Coming up, I'll be talking about your tax dollars and the Goofie Award, plus I've got 3 different shocking stats of the week, all of that coming your way. But right now, very pleased to have with me Greg Weldon. Find him at Weldon Online, weldononline.com. Greg, let me just get you to reiterate something there. If you're looking around for currency exposure, obviously if we're Canadian, you're saying you've got to have some of that U.S. exposure. Is that pretty much across the board? It's sort of U.S. dollar first?
You know, not necessarily. I have to say, I mean, frankly, and it's a little tricky here to kind of suggest why this is happening, but some of the European currencies actually look pretty good here. Stuff like the Hungarian forint, the Polish zloty. There's a couple of them, and Norway's also benefiting from the crude oil situation. And even the euro, to me, doesn't really look that bad. And you would think, given what's going on in the banks over there, and given that their stock markets have underperformed, given that you still have problems with the data that's just come out from Spain and Italy, Spanish budget numbers were not good. It is kind of difficult to figure out why, but then you say to yourself, well, if the U.S. is potentially going to raise rates, the U.S. bond market kind of loses its flight to safety label, and all of a sudden the German Bund becomes the flight to safety. And from that perspective, I think you've actually seen some demand for euro created by a potential crisis in European banks. Mm-hmm. So that, you know, that may be a stretch. I'm not sure. I really can't quite put my finger on it yet. But the dollar to me is sideways. And right now the dollar, I think the Fed is happy to have the dollar sideways. They don't want it to go up because that would be damaging to commodities and emerging markets, and you might bring back into play the international risk that they talked about just a couple of months ago. And from the perspective of meeting their inflation goals, that wouldn't be positive. But they also don't necessarily want the dollar to go down too much here either, because then that could lift energy prices and put them in more of a sticky situation down the road as it relates to just the calendar effect on CPI. So I'm looking at kind of some of the peripheral currencies, stuff that might have once been called exotic currencies, and even to the degree that I think, you know, you could just simply be playing the Russian ruble and the Norwegian krone here. Some of the, I mean, even the Brazilian real doesn't look too bad. The Indonesian rupiah, like I said before. So no, I'm not really focused on the dollar because I don't see a big trade there. I might play maybe a great cross idea would be to be long the Norwegian krone against the Canadian dollar. I'm kind of insulated from the oil impact there as well.
Interesting. Like, I can't let you go without talking about gold, though. I mean, you've done very well in the gold market over the last, I guess it's nearly 9 months now. You know, whether it's in stocks or whether it's in the metal. Excuse me, Greg. Just get your perspective on gold at this point.
Yeah, we've done quite well in the gold. That was a good call at the beginning of the year for sure. More recently, as you know, we got a little more cautious, thinking there was a correction coming. You got kind of a correction. You actually had a correction to the upside in the gold-silver ratio, which was interesting. But what that meant was that gold did not meet its downside targets. The first Fibonacci retracement, for example, is 1250. You really didn't even get close to that, whereas silver actually hit its first downside target. And I would add, very important too, that the CFTC Commitment of Traders report continues to show excessive bullishness in terms of speculative positions in both gold and silver. And I would throw in as a little added bonus, what looks really much more solid to me in terms of the whole setup is some of the industrial metals here. Tin, always a leader, up and down, is leading to the upside. It's had a really nice rally, long-term breakouts taking place there. You also have aluminum, you also have lead, and you also have nickel kind of pulling up the rear here. And the DBB, which is the base metal ETF trading in the U.S., broke out and reached a new multi-month high on Friday. So I think it's time to wait and see on the precious metals, but it's time right now to get involved in the industrial metals.
You know, it's absolutely, well, this is what's so fascinating about the markets in general, and they're so scintillating to see the different variables having an impact. And of course, in Canada, I think there's more than one company that'd be very happy to think that we've bottomed out when you come to the base metals, the industrial metals, and are now ready for a leg up. The Canadian economy could certainly use it when we're sort of chugging along under 1.5% growth for the year. So, yeah, that'll be a very interesting comment for Canadians.
You know, I'd throw in one more thing, too, that I forgot to mention earlier about Canada, because it's also kind of supports the bearish Canadian dollar theme, and that is the really interesting speech that your central bank governor, Paul made Monday, and talking about how growth in global trade will no longer kind of exceed global GDP growth to the same extent that it has in the past. And he says it's going to be more challenging for central banks, specifically in a place like Canada, where it's a commodity kind of based economy. And his quote was, "This will require more variability in exchange rates and interest rates. And a central bank that does not rely on a model that takes into account these things will be more, potentially impacted by external shocks." So to me, this was a clear case that suggests that again, the Bank of Canada is totally in play here. They're expanding their balance sheet. They easily could cut rates again now, given the CPI number we just got. And you get comments like that from your central bank governor, which basically says, we need to think outside the box in terms of kind of how we approach this on trade. That's really interesting to me. So I think the Canadian dollar is a really good candidate. And technically, you got very clear-cut breakdown levels here that were just tested last week.
Well, I'll tell you, it's going to be a fascinating going forward. There's, so much manipulation, but a great example there with the central bank take on things. As you say, Canadian dollar in play, Canada in play overall. Greg, we appreciate you sharing your insights with us, and thank you very much for contributing to our Inside Edge.
It's always my pleasure, Mike. You do a great job, and I'm happy to be part of it.
Great stuff with Greg Weldon. Go to weldononline.com, weldononline.com. Coming up, I got my shocking stats for you, so I got to get that stuff all set for you. We've got one from the world of entertainment. That really did shock me. I got to tell you on that one. But going further on that, we've also got one from the world of sports. The list just keeps going on, so lots of stuff. I just mentioned, by the way, the Inside Edge. Great stuff with people like Eric Coffin, Greg Weldon. Man, they ever made a lot of money for our subscribers with big wins. We also have Mark Leibovit, who's made a lot of money in the marijuana sector for people warning. We've got Tyler Bullhorn talking about the bond market. So, yeah, we've had a lot of world-class analysis on the big picture and the trends. I also chime in myself with stuff. I got something ready to go now. But as I say, this is a business where being right helps, and Greg Weldon has been a big help to us in getting things right. Great service, by the way. It's only $19.95 a month or $199 a year. That's the Inside Edge. If you go to moneytalks.net, you can sign on to that. Look, I got to take a break. As I say, I'll come back. Going to be talking shocking stats on the Money Talks Network. Coming up, I've got Neil McIver with the big fat idea. Plus, I've got Ozzie Jurek, who's been working on the latest numbers. You know that what happened in August was a huge decline, especially if you're talking the Vancouver area in terms of sales. Well, we said automatically you've got to see if there's follow-through in September. Well, wait till you hear these preliminary numbers that Ozzie has got together for us in just a couple of minutes' time. But time now for the shocking stat of the week. Let's start with one from the sports world, because I'm a big hockey fan, as I hope many of you are. But come on, it's a shocking stat that Brad Marchand led the World Cup in goals, including the cup-clinching win on Thursday. People in Vancouver are choking on that fact, given, of course, his infamy for what happened in the Stanley Cup rivalry between the Boston Bruins and the Vancouver Canucks. But I'll tell you, come on, how much money would you have made if you had bet before the tournament started that Brad Marchand would have led the scoring? That's one shock. Let's get one from the world of entertainment. This one's just so bizarre because I wouldn't have done it without seeing it so often. I thought I had to mention it finally. Lots of talk this week about Warren Beatty, who was once estimated to have slept with 12,775 women. Come on, that's a little bit of a shocking stat. That was done by biographer Peter Piskin. He's the author of Star, How Warren Beatty Seduced America. Well, no kidding. I think he made his way through Kansas, at least with that many. I'm still doing the math, But if at 12,775, if Peter Biskin estimates, that's one partner, a different partner every day for 35 years. Now, Warren Beatty said, I think I'll be dead if I had done that. But anyways, let's say the number is off by 90%. That's still 1,275. Come on. No wonder Warren looks so tired. But now I've got to get a little more serious with this shocking stat. This is what I think, I know that the press and the public is more interested in celebrities and the drama of the presidential election or the NFL season. But that does not mean the world is out of the woods financially. Case in point, you heard Greg Weldon refer to it. You heard Victor Adair refer to it, and that's the Deutsche Bank. This is a monster story. Germany's biggest bank has also the world's largest, what they call derivatives book. It's the portfolio of financial contracts that are based on the value of other assets. In the whole world, it's got the biggest. They are estimating it may be as much as $75 trillion. That's why I say if something happens with Deutsche Bank, the ripples will be felt throughout the world. By the way, their derivative exposure is 20 times bigger than the entire German gross domestic product. At any rate, they own about 12%, by the way, of what's available in the world. But here's the big thing. Their revenues are down 28% this first half of the year. It lost 6.8 billion euros last year. I'm telling you, if Deutsche Bank goes further, we are going to feel it here. The stock, as we alluded to earlier, is down 74% from its peak. Now, here's the thing. The U.S. government is considering imposing a fine around $14 billion on the bank for selling faulty mortgage-backed securities in the run-up to the financial crisis. That's basically what the entire company is worth. That's its market cap. So pay the fine and be worth close to zero. That's what's got the attention. We had several hedge funds clearing out of Deutsche Bank this week. Don't want to clear any trades through them. Well, that starts a little bit of a panic, a little bit of a shake. And as I say, the financial world is watching, but it's one of those events that would impact all of us. That's this week's shocking stat. How did it get to that degree is really beyond me. I'll take a break. I'll come back. Neil McIver on deck, and I've got Aussie Jurek with the latest numbers. Maybe they should have been my shocking stat. All of that on the Money Talks Network. Coming up, Aussie Jurek has been looking at the numbers. We've been saying all along that, of course, August were very disappointing numbers, huge drop-off in activity in the greater Vancouver area. But we said we've got to see if there's a follow-through. Well, he's got the preliminary numbers. He just dug them up for us. He's going to be with me in just a couple of minutes. We'll get to that. But right now it's time for the big fat idea. Neil McIver, McIver Wealth Management, joins me on the line. Neil, first of all, appreciate you taking time on the weekend for us. And I wanted to start with what you've been doing within your portfolio, your management, the kind of returns that you've been getting, what you've been focusing on.
Well, the portfolios that we run, Mike, and first of all, good to be with you and your listeners this morning, but the portfolios that we run are properly diversified portfolios, and they're mathematically non-correlated. So that means that there's positions inside of them that don't go up and down in unison, and that really reduces the risk quite dramatically. So we're going to have components of cash, bonds, high-yield investments, that would be corporate bonds, preferred shares, U.S. stocks, international stocks, Canadian stocks, and we're going to hedge all of that with gold or food production. And what that does is that greatly reduces the volatility and over time is going to produce superior returns because you're not going to get the downside. But a portfolio like that, if we look at, say, our P3 portfolio, which is sort of right down the middle in terms of risk and return, that's going to get, over the last 6 years, that's returned about 9.16% over that time frame with a very low standard deviation of about 7.4%. So those are the types of portfolios that we run, and again, they're designed to reduce risk dramatically over time.
One of the things you just mentioned there, though, I think is an absolute key, and I want to just come back to it, when you go on a non-correlated portfolio, because I think this is what modern portfolio management has to incorporate. And I'll give you a quick example of where it's not correlated. Where it is correlated, rather, and that's when you think you're diversified because maybe you own banks and maybe you own I don't know, a utility, etc. But when the interest rates move, they're all going to go down together. Or when we've had these major stock market declines, everything goes down. That's not correlated. I mean, that is correlated, and that's not what you want.
Well, that's right. I mean, many people believe that a properly diversified portfolio is owning both oil and natural gas, and that's not what we're talking about. So non-correlated positions. So if you're going to own a lot of fixed income investments or a lot of banks, you're going to want to own gold or something that's going to go in the opposite direction when the interest rate turn finally happens and interest rates go back up. So non-correlation is something that we can actually identify now using computers effectively and using the power of them to look for negative correlations in the markets, maybe even some that you hadn't realized before. But that's the single biggest issue, I think, in my business that I run into when I take a look at portfolios that have underperformed for the past number of years or even decades, is that positive correlation, people owning, all fixed income or all interest-sensitive securities inside of a portfolio.
Yeah, and they all move in the same direction, whatever the move is. I couldn't agree more with you. Now, one of the things we chatted about a little bit, so I get a little precursor, is you're thinking, just going to talk to Ozzy about it, that maybe it's time to take a little money off the table if you're talking about Vancouver, et cetera, in the real estate market, and maybe look at something, a non-correlated portfolio.
Well, absolutely. And my big fat idea this week, and you had one a couple of weeks ago, I think, with when Victor hosted the show, and that was about selling real estate in one part of the country and buying another. But I'm going to take the radical position that I think it's a good time to consider taking some profits off the table in real estate and investing that into the capital markets. Now, that probably won't make me a lot of friends in the real estate business, but that's really not what we're here to do. So to be clear, no, this is not your primary residence that I'm suggesting. This is investment properties, homes, apartments, townhouses, that type of thing, and consider moving those types of investments into a portfolio in the capital markets that's fully liquid.
Okay, and moving that, as you say, into the capital markets, obviously you need to link up with somebody who's got some portfolio management experience and a good track record, I should have said first.
Well, that's the key, is trying to find that. That's not an easy thing to do, but finding a talented portfolio manager that's got a steady hand and a track record that goes back. But just to give you an example, if you take a look over the last 6 years in the Vancouver real estate market, and we're focusing here on Vancouver just because there's been such a meteoric rise, but Vancouver detached homes have grown at an average rate of 11.5% over the last 6 years, from January 2010 to January 2016. But if you look at townhouses, the rate of return has been about 4.53, and condos just about 3.51. But if you look over that exact same time frame, that same portfolio that I was talking about earlier has had a rate of return of about 8.26%. And if you built a portfolio maybe that's a little bit more growth oriented, our P5 portfolio, not to toot our own horn, but that portfolio was averaged about a 10.23% rate of return over that exact same time frame. Now, obviously, past performance doesn't guarantee future performance. That's true for real estate or our models. And to be fair, the real estate numbers that I gave you don't include rental income. But the real estate numbers also don't include transaction costs, maintenance costs, taxes, rental costs, special levies, strata councils, headaches, all the things that we know take place with owning investment real estate. So I think the time is right, and I think it's going to provide the average investor with greater liquidity and certainly more diversification, because one of the things I think that people forget is when real estate when an asset like real estate rises the way it has in much of the country, people become too concentrated in that one asset class. Just as we were talking about correlation before, they become too concentrated in one asset, and that effectively increases your risk over a period of time, and you don't want that to happen. So it makes imminent sense, I think, right now to take a little bit off the table.
And again, this would be appropriate whether you're an aggressive growth kind of person, a conservative kind of person, doing some sort of mix kind of person.
Absolutely, really for anybody, provided that real estate is not, of course, your primary home. It's important to leave that out of the equation. But absolutely, and you can even leverage the strategy that I was talking about. One of the reasons why people have such a good experience with real estate is it's primarily leveraged for everybody. So even if you do get a 3 or 4% rate of return, if you're only putting 25% down, that's giving you a rate of return in the range of 8 to 10% over a period of time because of the leveraged effect.
And as you say, I mean, when things, whatever asset you happen to own, we're talking real estate because it's driven so much, it then starts to dominate your own financial picture. And you got to maybe readjust a portfolio like you would if the oil stocks went crazy or the gold stocks went crazy. You know, you readjust and get back into that balance, as you say. Neil, thank you so much for taking the time. Great stuff. You can find more with Neil at McIverWealth.com. MCIVER wealth.com. Neil McIver, McIver Wealth Capital. Thanks, Neil. I'll take a break. I'll come back. I'm looking forward to this. Ozzy's been doing some work for us, as he does every week. But, hey, we've been saying we've got to figure out what's going on with the overall market. Let's find out what at least the preliminary numbers are when we start talking September with Ozzy Jurek when we come back. I'm proud to say on Money Talks, we've been chronicling a slowdown in the real estate market for the last 4 months. We got those August numbers thanks to Ozzy Jurek. They were obviously like falling off a cliff, but again, it was the summer. So we said from that point on, we've got to see what's going on in September. We're doing that as we speak. Ozzy Jurek has got the preliminary numbers for us. Ozzy, let's start with the overall sales.
Well, you're quite right. You know, we were sort of saying, okay, there was a foreign tax, but August was August, there was summer and so on. But September, October will tell the story. Well, if that's the story, it looks like just on a first look, and that the numbers are going to change over the weekend, so don't hold me to the exact numbers, but it looks like we're going to be down between 45 to 50% in sales. And the biggest hit is the detached sector. I think on the detached alone, it looks like we sold about 480 units. Last year we sold close to 1,300, so that's a 65% decline. And when you look down on the condo sector, it's not nearly as bad. We're only down about 33%. Townhouses, we're down 50%. That's overall. But, Mike, if you go to the west side, the detached home sector is now down to 38 sales in September versus 137 last year. And the condo sector was 237 this month. Last year was 453. And townhouses, again, 50% lower. And whether it's the east side, single-family homes down 65%, or Richmond down 68%, or Coquitlam, the biggest hit is the single-family home. Now, we always talk about the foreign investors, but this affects us locally, too. Look, 800, no moves, about 800 single-family home people didn't move, right? So the moving van industry is affected. Maybe new furniture 800 times not 800 new mortgages, and not 800 property transfer taxes either for the government. And that's just in the single-family home sector. Overall, looks like we're down about 1,400 sales over last September. So it would have an impact on everything.
Yeah, I mean, I'll come back to that in a sec, but it comes at the same week that we got, Credit Suisse was calling us the most bubble city in the world when it came to our real estate prices?
Yeah, and they make the point that we're unmatched on the planet. So they have an index. It's UBS Global Real Estate Bubble Index, and we are number one in the world. He says we used to be in the top 10, but now we're number one. And they're saying essentially investors are less likely to see growth in property values in high bubble risk cities, and particularly ours. We scored the lowest, which makes us to be lowest in terms of all the factors that make up the index. That's why we're the number one city to be avoided from an investor point of view.
Let's come back then to the numbers that you just gave us. As you said, they are preliminary, but they're certainly giving us a very strong trend. The trend isn't going to change, and the ripple effect can be significant. I had said right at the outset when they did the foreign buyers tax, which I appreciate was a political gesture to all the outcry about foreign buyers and rising real estate prices, all of that kind of stuff. And but I said we better be careful what we wish for here, because we're talking in 7 of 10 provinces in the country, real estate's the strongest industry. Obviously, that's the case, led by British Columbia. So, this has significance. The sort of growth that British Columbia had been enjoying can ripple right through the rest of the country if we start getting a slowdown there.
Well, there's no question, and particularly since most of the increases is really Toronto and Vancouver. I mean, in our newsletter this week, we're recommending people look at Kamloops. I mean, Kamloops wasn't affected at all. The average price is $419,000. The BC average is $560,000. So there's a good upside there. So, but now when we have this negative feeling, and maybe a lot of the downturn, Mike, is still psychological, where people say, you know what, I'm going to wait this out. And we still hear about multiple offers and Mission, for instance. So it's not, a market, but the numbers quite clearly have had an effect, and if that continues in October and November, then we're going to back off even more. That's the kind of trend we have. We always buy at the very top, and when you actually should be maybe looking around, you're too scared and we stay on the sidelines.
Well, we'll be here to chronicle it. Thank you so much, Ozzie. Appreciate you doing the work to get those numbers first hot off the press for us. Ozzie Jurek, of course, is here every week. And he, by the way, he had a tremendous response to his ebook, Real Estate 2.0, on Amazon. If you were one of the people who downloaded the book, hey, do me a favor, read the book, send in a review to Amazon. That would be great. You can find more on Ozzie at Jurek.com. My thanks to Ozzie. Thanks to all our guests. And it's time now for the Goofie Award. And a reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment, which means you get paid first. There are no fees attached to it, and it's in the tech sector. For more information, go to soleraclub.com. Okay, when it comes to government spending for both individual elected officials and for bureaucrats, I don't think it's too much to ask that they spend our tax dollars as carefully as they would their own money. That's my rule. When 3 bureaucrats, for example, spent $12,000 for meals at the Paris Climate Summit, we know they wouldn't be doing that if it was their own cash. I know it's small potatoes compared to what, $300 billion the government might spend this year, but it's not an excuse to be so cavalier with our money. They're not spending their own money, and it has to be treated that way. So again, my rule is straightforward. And looking at the various spending scandals and waste, I don't want to jump all over people, but I will ask the question, would you have spent that same money if it was your own dollars? Would you manage it the same if it was your own dollars? Which brings me to this week's Goofie Award. National Film Board spent $96,000 on focus groups and workshops for its own staff between November last year and June. But here's the kicker. That included $75,000 to determine office layouts and workplace strategy. I mean, this is crazy. How about having a meeting instead with the staff? What do you think management is there for? You can send a little questionnaire out to the staff, whatever. My bet that if you looked at all the tens and thousands of moves that business have done or nonprofit charities, et cetera, have undertaken the last decade, not one would have spent that kind of money on focus groups for their own staff instead of just talking to them. By the way, I don't think anything untoward happened here. It's more frightening that this is how government operates. This is a bureaucratic mindset. Talk to someone. Nah. Worry about productivity, waste time. No way. Instead, let's have a committee, hire consultants, get a report, and make the move. Oh, my goodness. That's all the time we have today. Please go to moneytalks.net and join us on Michael Campbell's Facebook. Go out and have a terrific weekend.